The headline of an April 27th MarketWatch article read, 7 reasons stocks are better than real estate. Hey, look, I love stocks, but the article is very one-sided, giving all the pros of stocks and all the cons of real estate without any balance. I'm going to correct that wrong and tell you why I also love real estate, so stay tuned. Hey everyone, I'm Don Owen, and this is DFY Informed. Thank you for watching, and if you like this video, please give me a like at the end of it, and also feel free to hit the subscribe button at the bottom right-hand corner of the screen to follow my channel and see other debatable topic videos. Now let's get started. So I'm going to link the following MarketWatch article in the description. It's written by Sean Langlois, an editor for MarketWatch. I looked him up on LinkedIn, and as I suspected, he's got a Wall Street background. In the article, which I'm scrolling on the screen now, Sean makes some valid points about stocks relative to real estate. But you see, it's only part of the story, a half-truth, if you will. Now I'm going to tell you 3 things that this MarketWatch article fails in a big way to mention, and you can, as I always encourage, decide for yourself. So here's my first point. It's easier and in my opinion safer to use debt as leverage to invest in real estate than in stocks. If you watched my video on good debt versus bad debt, which I'll link up to the top here, you'll already know where I'm going to go with this. A property is a tangible asset with long-term intrinsic value. Yes, a property can go down in value, as we witnessed during the late 2000s housing market crash, but that's a relatively rare event. Banks know this. They're willing to loan out significant sums of cash, as much as 80% against that asset to secure the loan. For secondary residences, the max is usually around 70 to 80% of fair market value. Of course, I've never taken more than 50% of loan to value. Now, why do I stick at 50%? 2 reasons. The first is I don't want to be underwater on the loan, meaning I don't want to owe the bank more than the house is worth in the event I need to quickly sell the house for cash and the housing market happen to be in a slump. The second reason is that I like to be getting at least twice the amount in rent as I have for a mortgage payment. And for me, I found the 50% loan to value to be right in the sweet spot. It allows me to get a great return on a relatively small amount of my cash being used. And I'm going to talk more about that during my second point. With stocks, there are really only 2 ways which I'm aware to use leverage. You can buy stock options or you can purchase stock on margin. So buying the option to purchase or sell at a future date is a way to use leverage with a little bit of cash and turn it into a whole lot of money. But this isn't even well understood by or even available to many retail investors. Plus, it's quite risky and solely dependent on if the stock does what you're betting it's going to do price-wise in a given window of time, usually a very short window. Buying on margin means borrowing money from your brokerage using your existing portfolio as collateral to purchase more stocks. Folks, in my opinion, this is playing with dynamite. I had friends back during the dot-com era that lost just about everything they had by doing just that. You see, when stock prices start plummeting, brokers can exercise their right to margin calls, meaning you either have to put in more cash or they will liquidate some of your existing stocks to cover the cash need. If those stocks are dropping in value, you have no choice but to lose money. And while I know it's theoretically possible for a bank to call a mortgage note early, I've never really seen this happen, regardless of what housing prices happen to be doing at the time. So point number 2. In my experience, because of the first point, the returns on invested capital are significantly higher on real estate, on average, than on stocks. When you invest, say, $20,000 in a stock, that $20,000 is now off the table for your use in any other way. Yes, stocks have great liquidity, meaning they can be sold in a matter of seconds. But stocks in the short term can be up or down from your purchase price. They're highly volatile. If you need to use any of that $20,000 for anything else, you'll have to cash in stock to get at it. So now I'm going to tell you about the worst performing property I ever had. I say had. Yes, I had it. And it was my only headache property, so I sold it after 5 years. So here was the scenario, and this is real. All right, I originally paid $40,000 for it at auction. It was a foreclosure. I had to put another $18,000 in just to get it in nice rentable condition. So then I had it reappraised. It appraised at $80,000, at which time I took a 50% loan to value at 5% APR. So now I had my original $40,000 purchase price back in my pocket as cash. I rented it in less than a month for $800 a month. My mortgage was $264 a month. So net rent after paying mortgage was $6,432 for the year. Subtract $2,000 a year for taxes and insurance and another, say, $1,000 for miscellaneous repairs, and I was still left with $3,432 in free cash flow on an $18,000 cash investment, or about 19.1%. Think of that similar to a dividend on a stock, because that's cash I now have, not when I sell the asset at the end of my holding period. In fact, when I did sell the property, a relatively fast sale at $78,000, and figured up all the in cost versus all the out cost and the positive tax effect from getting to deduct depreciation, I calculated an internal rate of return of about 23% annually. And that was my bad property. Folks, I've been investing in stocks for over 25 years, and while I've done pretty well in stocks during that period, I don't come close to averaging a 23% return annually on my stock portfolio. This brings me to my third point. You have the power to increase the value of your real estate, mostly independent from the overall market, and that's not the case with stocks. If you own a stock, unless you're someone like Warren Buffett or Carl Icahn, you are absolutely powerless to influence the price of that stock. You are totally at the mercy of institutional investors, the geopolitical climate, investor psychology, and any other shock event that happens to be in the market, either positive or negative. Yes, if you're a huge Disney fan and you visit the theme parks every year and see all the movies, you might feel good owning stock in that company because you like the product. But rest assured, you doing those things or not doing those things doesn't move the Disney revenue needle 1 nanometer. Just think, in 2016 alone, Disney World in Orlando drew over 20 million visitors. And in 2017, they sold just over 266 million movie tickets domestically. Now I'm going to do another video on some of the things that go into determining the price of a stock. But for now, know this. Any news that is public, it's already baked into the price of the stock when you purchase it. It generally takes positive surprises in earnings to move the stock price up from your purchase price, and then misses on expectations tend to move the price lower. You are powerless to influence that. When I bought my houses out of foreclosure, they were trashed, but it was mostly cosmetic. Still, anyone who didn't feel comfortable doing work on a house wouldn't have touched these. Thus, I got them for deeply discounted prices. With some money spent on materials and a couple of months of my sweat equity, when I had the houses reappraised right before renting them, the value almost was always twice what I had paid for it. And there are things that I can continue to do once it's occupied. I can invest in upgrading the landscaping. I can, say, hang ceiling fans or upgrade fixtures throughout the house. I can add chair rail and crown mold and other cosmetic enhancements. I can enhance the outdoor living space. There are dozens of things that I can do to increase the value of my property. Look, I think that any great retirement fund portfolio has to be invested in stocks. But to say that stocks are a better investment than real estate, I'm sorry. For me, I can't figure out a way to beat what I consider a relatively safe investment in real estate without employing some very risky strategies with stock. So that's my experience with residential real estate. I have to say, it's become a very stable part of my retirement portfolio. If you want to read an excellent book that explains the investment in and management of real estate, I recommend Investing in Real Estate by Dr. Gary Eldred. I've put the link of this book in the description of this video, so you can click on it and it'll take you to that book right on Amazon. As always, thank you for watching, and remember, Decide for yourself, informed.